Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Let's bring it back to the United States and turn to the US consumer. Retail sales due at 8:30 Eastern Time. The report coming after a disappointing UMich consumer sentiment survey dropped going into the weekend. Airlines are leading the way as corporates start to lower guidance. Delta, American and Southwest slashing their outlooks, citing weaker than expected demand. Trent of Citi still optimistic on the sector, writing the main risk seems to be top down. When and how do we get clarity on the government's plans on tariffs, trade and foreign relations? Stephen joins us now for more. Stephen, good morning. Good to see you.
Same. Thank you for having me.
I think we've got to start with the downgrades to the outlook for the first quarter that came from some of the airlines, and it was kicked off by Delta just last week. Ed Bastian used the T word. The T word's a scary word on this programme. Transitory. Transitory. Just how transitory might this be?
Great question, and I think it's too early to say. So you did have a lot of noise in 1Q. Certainly, as you guys said, the airlines really dislike this uncertainty. So when are we going to get clarity on tariffs, on Dodge cuts, and what does all of this mean for demand? I think that's too early to say. During this quarter, at least so far as well, you did unfortunately have several high-profile aviation accidents. All but one of them were fatal. That is also something that you can't ignore in these short-term moves. But I think overall, what confidence do we have 6 months from now? I think it's way too early to tell. And the underlying fundamentals still look positive.
So let's gut check ourselves, because before we get carried away with too much negativity, not that I would ever be accused of that, I am wondering if it really was all that bad, what some of these airline executives were projecting.
Yeah, so look, I think if you look to your point, nobody so far has changed their full year guide. I think they're also in a wait and see mode to some extent where things go. Are we going to wake up a month from now and we'll have a little bit more clarity after this April 2nd bogey that Mr. Bessemer mentioned? Are we going to wake up and have some wild headline about Greenland and nobody wants to travel? I think it's too early to say, and it's a little too hard to put math on that today. But the underlying fundamentals still look positive, and I think the airlines telegraphed that by not making any cut to the full year guides.
There was a real question about how much of this was driven by consumer discretionary spending, people who might be worried about losing their job, versus companies really pulling back, saying, hunker down, study, you have got nothing to tell any of the clients.
Yeah, look, I think those are all potentially legitimate drivers. I would add to that what's happened on the government level, which is not the largest piece of travel, but with DOGE kicking in, less government employment, I would imagine they're also being stricter about who's allowed to go on business trips from these various agencies. So I think all of that stuff is relevant.
They certainly are. I hear that anecdotally, but also we saw it with United. Who is most vulnerable to that, those government contracts, those government flights?
Yeah, certainly United had not a massive number, but American United kind of sort of talked about having a smallish percent of revenue associated with U.S. government travel. So I don't remember exactly off the top of my head, but very low single digits, I think, in the highest case.
So not enough to pull roots?
No. But you also have to consider some of these markets where the government serves. So Washington, Reagan, of course, where we just had one of those awful accidents. The FAA had actually added a little bit of flights into that corridor recently. So you have a difference in terms of how much flow you get from some of these government employees and what kind of economics you get on them. So they were small numbers. But I think the question is, when the dust clears in all of this, how big are they going to be? We don't really know yet.
You also mentioned fuel prices in your note. A lot of banks are now cutting their forecast to Brent. How much is that going to be very helpful right now for the airlines?
Yeah, so I think lower fuel prices are helpful, and fuel's sort of a funny thing. You know, fuel prices that are too high are bad news. Fuel prices that are too low, also bad news. You know, the latter signals a recession, for example. But where we are today with, you know, WTI in kind of the high 60s or thereabouts, it's at a level where it's not really doing any damage, or it's not dangerously cheap per se. And it did come down from levels where we're going to see lower unit revenue, at least short term. So it's actually good to have a little bit of tailwind from fuel today, you know, but I guess if fuel started to, and crude started to fall wildly, that wouldn't be the best signal in the world.
So I think a couple of things we're still talking about. One, did the weakness in February spill over to March? And within the weakness, is the premium segment, the international long haul, still holding up?
Yeah, so what we see so far, international long haul is still strong. You have a dearth of new equipment per capita in that space. On the wide body side, you really only have now with Alaska, you have 4 U.S. airlines that have any wide bodies, really. And loyalty and co-branded card, the same. Domestic's been the main place so far that's been a little bit soft. And, you know, the indications so far is that should at least continue somewhat into March, but, you know, too early to say what's going to happen on the month.
Let's finish on domestic. What happens when you start charging for bags? What happens?
Yeah, it depends who you are.
What if you're Southwest?
Yeah, look, so I think on one level, if you're a carrier that's for decades been dealing with passenger flow that is elastic in terms of demand, it's a give and take, no? So I think what you're going to pick up and check bags, you're also going to run some risk of sending some passenger flow away to somebody else. And that also makes you arguably less distinct against basic economy of one of the big three. You're now offering something similar to them, and they have a massive network versus you if you're Southwest.
Begs the question, why did they do it? What's the logic behind it?
So I think for the discount airlines, there has to be some kind of change strategically speaking. I think these post-pandemic structural challenges, the way consumers purchase tickets and decide to travel, all of that's changed. We no longer have enough air traffic control capacity per capita to allow these discount carriers to just lay a bunch of capacity and maintain really high block hour utilization. They need to do something on the unit revenue side. So is this going to be the fix? I don't know.
Just quickly, top pick right now for the sector. What is it?
Of the U.S. airlines, United's my favorite one, and then American Airlines and Delta.
All three then? All three of the big players?
We're fans of the network, guys. And they have everything they need to win. We just need the consumer to have a little bit more calmer water.
We'll get another read on the U.S. consumer at 8:30 Eastern Time. Stephen Trent, good to see you. As always, Stephen Trent there of Citi. Lotfi Karoui of Goldman Sachs looking for wider credit spreads, writing, since the first tariff headlines broke, our message has been simple. Add hedges and brace for some rebuild and risk premia. Lotfi joins us now for more. Lotfi, good morning. It's good to see you.
Good morning. Good to see you.
I want to go back several months. I want to go back to the note you put out at the end of 24, going into 25, where you highlighted just how severe the valuation constraints were coming up into the new year. How much of a role do you think that's played in some of the shakeout we've seen so far?
A little bit. Obviously, when valuations are expensive, you don't have a lot of room to stomach these big shocks. But back then, actually, our message was that, yes, the market is expensive. Add hedges, add downside protection, and then wait for any signs that things are shifting, either fundamentally or from a technical standpoint. What we've learned the last 3 to 4 weeks is that things are actually shifting fundamentally, but the trade-off between growth and inflation inflation is, in our view at least, heading into a direction that is unfriendly to risk assets. And so you have to realign yourself with that, and you have to push spreads a little wider.
Things are changing fundamentally when it comes to sentiment, when it comes maybe to demand that we're hearing from airlines, as we were just talking about. Has it really shifted, though, with the creditworthiness of these companies that have locked in borrowing costs for a long time and still seem to have healthier balance sheets than they have historically?
It depends where you look. If you're talking high-quality, IG-rated companies, probably not. I mean, if you implement tariffs, at the end of the day, it's probably worth a couple of points of declines in earnings. That will shift your credit metrics a little bit, but not too much. Where this will make a difference, in my view, is in the very low end of the high-yield market, where we ended the year with tight spreads in hopes that actually the economics of refinancing for some of these over-leveraged capital structures have gotten better. Now, I think what you'll see is spreads moving wider and that economics of refinancing getting a little bit more challenging again.
We just saw a week of the biggest widening in credit spreads going back to last summer's volatility. And I just wonder, is this a repricing of risk, to your point about valuation late last year? Or is this the start of something more significant where people shift maybe to places like, say, Europe and European credit over the United States?
This feels a little different to me relative to late July, early August, where we were actually pounding the table to buy the dip back then. This feels a little different because you need time to process what is effectively a meaningful dose of uncertainty that's been injected in the economy. The starting level for spreads is also very tight, and so it's not like you are being paid actually for this type of shocks. Europe has already outperformed, actually. Europe has had a phenomenal start to the year, both in credit and in equities. I guess I would describe European credit as basically being in the same situation as U.S. credit, 3 months ago, back to that valuation conundrums. So I think it's going to be very hard for Europe to continue to tighten in absolute terms. In relative terms, I think Europe will outperform the U.S.
There's this question at a time when the U.S. is potentially entering into a difficult patch of whether credit still has the canary in the coal mine aspect that it used to, whether it still kind of can forecast the sense of disruption in the fundamental economy that it had the reputation of doing 10, 20 years ago. Has that signaling mechanism been broken?
Yeah, I think that reputation comes entirely from the playbook of the global financial crisis. I don't think things will play out that way this time around. And so what we've seen now is literally credit moving in locksteps with its sort of empirical or beta relationship to the equity market. And so people complain all the time, well, actually credit has not moved. That's not true. We've actually repriced in terms of the change in spreads. If you look at the change in IG that would be implied by an 8.5%, 9% move in the S&P, it's exactly what you've gotten the last 4 weeks. And so it looks like credit is resilient only because the starting level is so tight. But if you look at the change in spreads, it's been commensurate, I would say, with the move in equities.
When John was talking about your note, you talked about the first headline from Donald Trump when it came to tariffs. Yeah. Why now? Trump has talked about this from the very beginning, and we knew this was one piece of his broader plan.
Why now? Great question. I think what we've learned is that the administration has greater tolerance for a move lower in the market and even a full slowdown in the economy. To me, that's been the most critical piece of information that we've learned. And then valuation has remained very tight. The two other things I would add is that, and this is a big difference between today and 2018. In 18, rates were very low. They're not today. Actually, you get paid 4%, 4.25%. To invest in cash. And so you have a very valuable degree of freedom. Duration has rallied too, from a peak of 4.75 roughly to 4.25, but can rally more if you have an even bigger slowdown. And so to me, the urgency to buy the dip today is just not there.
I think we all remember December 2018 when the credit market totally froze up. I think that month for high yield we got zero issuance in December 2018. Is there anything like that happening right now? Anything that would concern the Federal Reserve going into this two-day meeting starting tomorrow?
I think they'll most likely be in wait and see or on the sidelines. We'll learn, in terms of what they do with their own projections, how much they'll push inflation up and then how much they'll push growth down. But at the moment, like us, my guess is that they're processing this flow of information and trying to assess what they will do. Now, the market is pricing in, I think, 2 cuts for this year. That seems quite reasonable to me. You're pricing in 2 cuts not because you think we're going to make progress on inflation, but you're pricing in 2 cuts because you think the Fed will will probably adopt some kind of an insurance guts type of framework, exactly like they did actually in 2018.
Is the primary market still open for deals? We saw some headlines in the last week or so.
Risk aversion has gone up, and so the market is open 100%, but new issue concessions have gone up, and so, issuers have to pay a little bit more relative to the secondary to access the primary market. That's actually in and of itself, it's a healthy thing, because if you reduce supply, you kind of rebalance the market a little bit, and you bring stability to the secondary market.
What are you waiting to understand the depth of what kind of correction we could see, or whether this is going to become something that you can opportunistically go into?
So at the single name level, I would say you're already seeing some opportunities. I mean, certainly the primary market is one way to deploy capital and harvest a little bit of alpha. But what could change my view, look, two things. One, you get a valuation reset. So actually you front load a lot of damage, you price it in, you make spreads interesting, then you revisit the conversation. The second thing, I think we need to remember that in the administration's policy agenda, there's a lot of things that are pro-growth. And so if you recalibrate actually that policy mix away from some of the stuff that is actually negative to growth into some of the things that are positive for growth, tax cuts is a good example, deregulation, et cetera, then I think you have a different conversation and you would look at this market a bit differently.
I sense that's still the strategic anchor of a lot of the bulls out there, that the overall policy mix is still pro-risk, pro-growth, and in 6-9 months' time, things might look a little bit different. That's the hope anyway.
The first half of the year is Biden data, and then when Trump data comes into play,
we were told that.
Yeah, then there's going to be a policy mix that's more supportive to things going better.
Lotfi, it's good to see you. Thanks for breaking this down. Sharp as always. A clinic on credit from Lotfi Karoui there of Goldman Sachs. 27% of registered voters view the party positively in an NBC News poll. Unreal. Joining us now to build on some of these conversations, Henrietta Trezy of Veda Partners. Henrietta, welcome to the programme. Overall, I would say on net, the people that come on this programme don't like tariffs. There is some pushback sometimes, but on the whole, they don't like them. The market participants, they do like tax cuts. Now, we're trying to understand whether we'll get those corresponding tax cuts anytime soon.
Well, if you listen to the White House, they're trying to bill the one thing that is happening here, tariffs, as tax cuts. When Peter Navarro and other economic advisors in the White House come out and say that tariffs are tax cuts, that's obviously, either you're lying to yourself or you're lying to me, but it's not correct. And that's the problem that we run into, because the same is true on the tax cut side. As your previous guest was discussing, the bill that they're trying to pass, by Memorial Day, whenever it passes, I don't care, they're extending the status quo. So there are no tax cuts even built into the $4.6 trillion tax bill that they need to pass this year. So there are tariffs and there are not tax cuts. And when you sell tariffs as tax cuts, you create a pretty material disconnect between the consumer, who is confused now about what they should be expecting, which is why you see pullback at the big box retailers and people delaying big purchases, which is what's leading to that soft data that's so problematic right now.
Henrietta, what happened to the carrot and stick approach when it came to tariffs and corporate tax rates? I thought if you produced in the United States, potentially you could get a 15% corporate tax rate. Where did that conversation go on Capitol Hill?
That conversation is nowhere right now on Capitol Hill. Each percentage point reduction in the corporate tax rate costs $150 billion. So as I mentioned, we're already at $4.6 trillion just for the status quo. We got to fix the SALT cap, even just to raise it up to $20K for couples filing jointly. We have to extend the child tax credit. The president wants to do things like eliminate taxes on tips, which is itself $175 billion. We do not have the money for a 15% corporate tax rate. And even if you did, I'd like to relay that the Republican conference and members up there do not support additional tax cuts for the business community. They view the 2017 tax bill downfall. The one piece that was really unpopular is that the corporate rate cuts were permanent, and all the individuals in the United States are now subject to a tax increase at the end of this year because of the 2017 bill. So there's not a lot of appetite for tax cuts at the corporate level.
So Henrietta, what kind of extras can we get? Do we get no tax on tips, no tax on Social Security? What could Trump put on this to make it more than just an extension of TCJA?
That's a great question. The no taxes on Social Security is physically not possible. They're not permitted to address Social Security in any capacity using reconciliation instructions. So that's entirely off the table. And just so we're clear, the cost of doing that would be $1.8 trillion. So if it was not physically impossible, it's definitely monetarily impossible. The no taxes on tips piece doesn't have a tremendous amount of support because there's not been enough education or discussion of how to rein that in so that you don't avoid, a CEO saying the $1 million that I made last year is actually just a tip and evading taxes. So they don't have the logistics worked out for that. And then in addition, that's not a universal tax cut for all individuals. It's only a tax cut if you get tips, which not everybody does. So it's disproportionately impactful to different states. That was a big sell in Nevada, but Nevada does not have Republican senators. So it's going to be really difficult to get that over the finish line. There's not a lot in there that can be described even charitably as stimulative. There are a couple of business-related provisions that expired in 2022 that we could provide a short-term extension of, but that's really it.
Henrietta Trezy there of Veda Partners. Henrietta, thank you for the update. Appreciate it. To extend the conversation, Neil Dutta of Renmac. Neil, welcome to the programme, sir. You've noted the soft data, the anxiety over employment specifically. I just want your thoughts initially on retail sales. Do those two things stack up?
Well, I mean, the retail sales data was basically an online story. I mean, last month, a lot of the weakness that people didn't foresee was a function of online retail. And this month, a lot of the strength that people see was a function of online retail. So that kind of just swung around. If you take that out, the underlying story is still weaker. I think it's interesting that food services and drinking places, basically restaurants are down, 3 months in a row or down, over the last 3 months and pretty meaningfully over that period. I mean, that's sort of a bread and butter type of discretionary purchase. If you're not feeling good, you're not going to go out to eat. And that's exactly what's been happening.
Neil, you've been clear about how this weakening trend has been in place for quite a while, that really since late last year, you could start to see it in the data. And this is part of the economic cycle as much as anything else, if not more. I am wondering if you're surprised by the pace of some of the deterioration, especially in light of the pressure that increasingly is being put on the Fed not to cut rates because of inflation expectations.
Well, I mean, I don't think there's a smoking gun yet in the hard data. I mean, I want to be clear about that. There's no sign of collapse. There's no real discontinuity in the hard data. I mean, that's a classic Greenspan sort of tell for trying to figure out when, if we're in a recession or going into one. But you clearly see weakness in, soft measures of economic activity. And obviously there's been a fairly rapid speed in terms of the weakness in consumer sentiment. As an example, the March Empire data, sort of the same thing. Obviously, if you're doing tariffs, I mean, that's going to weigh on the goods sector, disproportionately, and you're seeing that. But you've yet to see that really translate into hard measures of activity. And I think at some level, Lisa, I mean, the fact that the economy, I mean, residential investment's been quite sluggish. A lot of the cyclical areas, manufacturing's been quite sluggish. So if these cyclical areas have been relatively soft to begin with, it mitigates some of the downside, because if you're sort of bouncing along the bottom, it's hard to go further down into the basement.
One thing that you've laid out, Neil, and I thought it was really profound, especially in your conversation with Paul Krugman over the weekend, was the degree to which some people are underestimating the amount of state and local funding that's being cut right now, and how some of the federal cuts might look really small on kind of a national spending level, but when you start to get those cuts at state and local levels, that's where it's going to bite more significantly. I'm wondering, how quickly are we starting to see some of those cuts filter into some of the economic data that we're getting out, like spending, like consumer confidence?
Well, I think the area to watch is really state and local government employment. I mean, that had been a steady tailwind for jobs growth over the last, year or so, and that's, shifting into a much lower gear. Remember, state and local governments were adding 30 basis points of GDP growth, and that's probably poised to go to zero, maybe even slightly negative this year. That's what we're seeing in the upcoming fiscal year. States have exhausted their pandemic relief money, that's already started to weigh on sort of public sector construction spending. I think, employment's going to be the next leg of that.
Neil, when it comes to this administration and their pain tolerance, over the weekend, Treasury Secretary Scott Bessent, someone I know you know well, said over the long term, if we have good tax policy, deregulation, energy security, then the markets will do great. But in the short term right now, the only policy we keep getting out of this administration is tariffs. What's their threshold for how painful they're willing to take what we're seeing in the financial markets and consumer sentiment?
Well, I don't know the level of the put. I mean, I just know that it's lower than where we are now. I mean, look, I do think it's more about what they're doing, not the uncertainty around what they're doing that's driving the markets. But, you know, I keep, you know, you and I have talked about this, Anne Marie. Did people not know what they signed up for? I think what we're seeing is when Trump won, everyone knew that it was some combination of tax cuts, deregulation, and tariffs. But they bet on it in that order, which is why you saw expectations for growth, at least in the first and second quarter, go up after the election. But obviously, we see what the order is, and any day that they're not talking about tax cuts and deregulation is a day they're talking about tariffs, and the signaling of that means that they're pursuing a lot of growth, unfriendly initiatives first.
Neil, why do you think there was this consensus around the sequencing? Because it's very clear, if you understand Washington, that the only lever Donald Trump could pull on his own when he got into office was unilaterally tariffs.
Well, yeah, I mean, I don't know, Anne Marie. Maybe you should get into the private sector forecasting business, because I think that was a great call. But look, I mean, not only that, I mean, any legislation was going to be a very, very tall lift as well, as you know, because the Congress was so thinly divided. I mean, I think at some level, because it's going to take them longer to get some of this tax stuff through the finish line, you know, that's probably why one reason why they are front loading the tariff agenda.
Neil, I haven't watched it yet, but people want to know, is Krugman Dutta going to become a regular thing? Do we get a second series?
Well, you'd have to ask Paul, but it was quite the honor to be on with him.
Neil, appreciate the input as always, sir. Neil Dutta of Renmac. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.